Welcome to the FinTech One-on-One podcast. This is Peter Renton, chairman and co-founder of FinTech Nexus. I've been doing this show since 2013, which makes this the longest-running one-on-one interview show in all of FinTech. Thank you so much for joining me on this journey. Before we get started, I want to remind you about our comprehensive news service. FinTech Nexus News not only covers the biggest FinTech news stories, our daily newsletter delivers the most important FinTech stories into your inbox every morning, with special commentary on the top story of the day. Stay on top of FinTech news by subscribing at news.fintechnexus.com/subscribe. Today on the show, I'm delighted to welcome Caleb Avery. He is the CEO and founder of Tild. Now, Tild is a super interesting company. They're in the payment space, and they provide what they call PayFac-as-a-Service. Now, if you have no idea what that means, don't worry. We actually go through the first half of this interview is basically a Payments 101 tutorial where we go through all the different, the language and the acronyms that is used in the payment space. So by the end of this interview, you will understand exactly what a payments facilitator is, or a PayFac, and what PayFac-as-a-Service actually means. So we talk obviously about what Tild does. We also talk about how they are able to compete with Stripe, the big 800-pound gorilla in the space. We also talk about the Visa and MasterCard Department of Justice settlement that just was in the news recently. Caleb's got some very interesting things to say there, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Caleb.
Yeah, thanks for having me on today.
My pleasure. So let's kick it off by getting a little background about yourself. Just hit on some of the high points of what you've done in your career to date.
Yeah, sure. So my name's Caleb Avery. I'm the founder CEO here at Tild. I started my career in the payment space at 19 years old, going door to door, selling payment processing to small business owners. Probably not what every sophomore in college was doing at 19, but thought that was interesting to me, and scaled up that first ISO. And between that business and Tild, I did a lot of angel investing and consulting for vertical software businesses. And, that was really the experience that gave me the lens into the problems for a lot of these ISVs and helped drive me, towards starting Tild.
So it sounds like you had the payments processing bug very early on. What was it that attracted you?
Yeah, so I think, thing one, residual income is definitely something that was pretty appealing to me at the time and remains, interesting today. But a lot of it started with just going out and talking to small business owners to understand, the pain points that they were feeling. And what was immediately obvious was that a lot of these small businesses hated the credit card processors that they were working with. They didn't like the fees, they didn't like the support, they didn't like the equipment. And so the fact that they were ready and willing to talk to a 19-year-old and trust them, with their livelihood showed me that there's a pretty big gap, in that market.
When you were 19, were you working for another company, or were you just starting up something from scratch?
We started up a retail ISO, and I think at the time we started under Priority Payments and later Pivotal, and we had numerous relationships, over the years, but hung up our own banner and just started out going out door to door.
Good for you. Well, I've been an entrepreneur for too many years, 37 years, I think. I've taken credit card payments the whole way through. It's always a painful thing, and you always feel like you're getting ripped off. So anyway, tell us about Tild. What was the impetus to found this company?
Yeah, so when I moved to Boulder about 9 years ago, I was starting to do angel investing and started getting connected with different investors, CFOs, founders within the ecosystem. And what I started to realize was businesses of all sizes and scales, startups first getting started, organizations with hundreds of millions in payments, organizations doing billions of dollars in payments. A lot of them were using Stripe, Square, Braintree, and they were making $0 in revenue on all of these payments flowing through their platform. And, fast forward 9 years later, if you're doing $500 million a year in payments and you haven't yet figured out payment monetization, you're in the minority. But 9 years ago, like that was the common situation that so many of these organizations found themselves in. And so for me, it was this period of several years where I saw the same problem dozens of times, where these software companies wanted to figure out how to go about monetizing their payments. But when they really looked at the existing landscape of options with gateways like NMI or Auth.net, working with the traditional processors, the TSYSs and Fiservs of the world, that legacy technology and the manual PDF boarding process wasn't really what these software companies wanted. And so for me, the actual like driving moment for me behind Tild was working with a software company doing about $1 billion of volume that thought they wanted to be a PayFac. And for me, that was really my first introduction to the PayFac model about 6 years ago. And the more I learned about the model, the more I realized why, the average vertical software company was really never going to be able to take advantage of going and becoming, a registered PayFac themselves. And so that's what drove me to create what became Tild, what became PayFac-as-a-Service, was this drive to create the opportunity for the average vertical software company to leverage the benefits of the PayFac model, but to launch in 1 week.
Okay. Interesting. Well, before we dive deeper into all of that, I want to actually go and do a little payments 101 lesson, or payments processing 101, because I know there's a lot of terminology in the payment space that I know I didn't know until fairly recently, and a lot of my listeners probably don't know. So we're gonna start at the basics, right? So maybe you could start and explain what is a card issuer or a card issuing bank versus a merchant acquiring bank. Can you explain the difference between those two things?
Yeah, so fundamentally on the card issuing side, that is the bank that's issued the credit or debit card to the consumer. And I think oftentimes the card issuers get mixed up with the card networks. And so people are thinking that, Visa, MasterCard, are the issuers on the card, when in reality it's the bank, that the consumer is working with. So it's Citi or Chase Bank that's operating on the card issuing side, working with the consumer to give them either the line of credit through the credit card or the debit card associated with their bank account. And then on the merchant acquiring side, the term acquirer oftentimes gets intermixed between the acquiring bank, which is the financial institution that's registered with the card brands to allow small business owners to accept credit card payments, and then the processors are fundamentally the organizations that are processing, those transactions and have the connections with the acquiring banks and the card schemes. And so there's all these different players that get intermixed together, but those card issuers are on the consumer side, whereas the acquiring banks are really on the merchant side of the equation.
So what is a payments processor then?
Yeah, so the payment processor would be the role that like a TSYS or a Fiserv play, that have the technology that merchant is using, and they facilitate the funds movement between the different, parties in the equation. And so, a TSYS is leveraging the licenses from a merchant acquiring bank like a Synovus. And that combination of the processor and the merchant acquirer is really what the small business owner needs to be able to accept credit card payments. And nowadays, the small business owners typically don't realize that there's two players serving that function, because a lot of the processors and ISOs have essentially bundled those services together and are kind of the single party that the small business has to work with in order to accept payments.
Right. Got it. Okay. And you said this acronym many times, ISO. That's ISO, right? So what is an ISO exactly?
Yeah, so an ISO is an independent sales organization. That's where I started my career, and fundamentally, at its core, an ISO is a distribution channel, a distribution model for these acquirers and these processors. And so, for dozens of years, the ISOs have typically been, the feet on the street or the call centers going out and helping sign up small business owners to leverage the technology and the relationships of the acquirers and the processors.
Mm-hmm, mm-hmm. Okay. And what about an ISV? How do you define that?
Yeah, the payment space is just mired in all of these,
Right.
acronyms and jargon, and I think it's made intentionally, complicated to scare folks. But the ISV acronym is for an independent software vendor. And fundamentally, the ISVs are typically verticalized software solutions that do far more than just payments. And so,
Mhm.
it could be a dental practice management software, a gym management software, a property management software, a restaurant, point of sale solution. And so they're coming in and providing access to a variety of different services to these small business owners. And more typically nowadays, payments is embedded or integrated into these ISV solutions.
Right, right. Okay. And then payments facilitator or PayFac. What are they and how did they come about?
Yeah, so when I think about the PayFac model and how that differs from the traditional ISO model, a lot of it comes down to the card brand rules and regulations. So Visa, MasterCard, Discover, Amex get together and really establish the guidelines and the rules for the process that a small business owner has to go through to accept credit card payments at their business. And under that traditional ISO model, every merchant is getting their own merchant account, their own merchant ID, and they go through a very thorough vetting process to get that account created. Whereas the PayFac model, which was really made popular by Stripe, Square, Braintree, PayPal, Toasts of the world, that have gone through a very extensive vetting process with the banks, acquirers, card brands to get registered as what's called a master merchant. And so once that PayFac is registered as a master merchant, they're assuming all of the liability for those SMBs that they board as sub merchants under their business. And so one of the primary advantages of that PayFac model is streamlining that onboarding process for a small business owner to sign up and start accepting payments really as quickly as instantly, after submitting that application. 2 minutes later, they could be processing payments under that PayFac.
Okay. And so that's different. Like when you were 19 years old knocking on doors, there were no such things as PayFacs, right? And
Really
so
not, yeah.
they would have to go and sign up with the payments processor that you were connected with and the merchant acquirer. But now, like, there's another layer that's been introduced, it seems.
Yeah, absolutely. And I think the PayFac model, originally when, Stripe and Square were first starting out was really more of a merchant direct play. How can we go acquire merchants and get, merchants processing payments as quickly as possible? And where, especially Stripe has morphed their business is really to be the payments infrastructure layer for the ISVs. And so a huge part of the Stripe and Braintree business nowadays is them signing up these ISVs and allowing the ISVs to leverage, the technology and that boarding experience that Stripe has created.
Right, right. Okay. And then finally, in our Payments 101 lesson here, and if you're watching this on YouTube, you'll be able to see the sign that's behind Caleb there. So he's got a logo of Tilde, it's a nice neon sign, actually. And then underneath it says PayFac-as-a-Service. So you've gone all in on this term. Explain what it is exactly.
Yeah, once you start buying neon signs, you're kind of committed to the
Right.
to the term. But for me, when I think about PayFac as a service, it's this idea of a turnkey, white labeled payments infrastructure model that allows ISVs to embed and ultimately monetize the payments that are flowing through their platform. And so traditionally, if one of these ISVs wanted to go become, a registered PayFac themselves, that could be a, 6 month, couple $100,000 process for that ISV. Whereas with Tilde, our average ISV partner is integrating to Tilde in about 9 days. And so we're creating this incredibly rapid path for software companies to come integrate to our APIs, leverage our white labeled solutions, and start generating revenue on every payment flowing through their platform.
Gotcha. So someone like Toast is already got all that set up. Like, I mean, I go to a restaurant, I see the Toast sort of terminal, and they've gone through this process a long time ago. They don't need your service, right? But then what you're talking about is someone who has vertical software, and obviously there's new vertical software companies coming on board all the time. But what you're saying is those that don't have, they don't want to go through the 6 month process. Tilde exists to basically speed the process up so they can get on board quickly.
Absolutely. If you're doing $40 billion a year in payments like Toast is doing, you can afford to, go through that process. Most of our clients are in that 50 million a year to 2 billion a year, range of payment volume. And at that scale, it's really difficult to justify the time, the money, the expense, the expertise required to go become a PayFac yourself.
Okay. Okay. So is that Tilde's like primary business now? Is this what you are a PayFac as a service company, or do you have other things that you do?
Yeah. So the vast majority of what we do really is that, till to ISV model. Occasionally we work with larger direct merchants, but that's certainly a small part of what we do. But increasingly we're starting to get interest from larger strategics that are wanting to white label the entire, Tilled technology set. And so I had somebody pitch it to me a couple of weeks ago as Tilled stripifying the legacy processors. And so that is increasingly becoming an interesting part of the business. But that's still an earlier model.
Right, right. So then do you deal with the ISOs, these people that still go and knock on doors? For those people, the ISOs or the ISOs, I know you call them. I should get the lingo right. Um, are you working with them? Does an ISO want to bypass Tilde and go straight to the processor? And what's your relationship there?
Yeah, so we do work with ISOs. Over 50% of our ISV, just to use all the acronyms, 50% of our ISV deals come from our ISO referral partners. And so
Okay.
we have about 180 different ISOs and payments consultants that go out there and outbound go find ISV opportunities that are looking for better technology, better support, better monetization experience. And those ISOs bring those deals to Tilde. And the question is, why do they bring, those deals to me when every one of these ISOs already has a direct deal, with one of the processors that they get far more revenue, on those deals than bringing them to Tilde. The reality is, if you're an ISO and you want to go bring, an ISV that you've sourced, they're ready to sign up. They don't like Stripe. They want a new solution. If that ISV tries to go partner, with one of the legacy processors, they're going through a very painful, could be a 9+ month integration for them to get integrated to the gateways, at these legacy institutions. And so they're bringing those deals to Till because we provide them better technology. We're providing a revenue stream, to these software platforms, and then we're providing them white glove support so that they can help get their partners up and running. And then those ISOs, make a nice, ongoing residual stream from bringing that relationship to Tilt.
Right. So I'm just trying to understand exactly what your software is doing in that situation you've just described. Is it just the fact that you have these connections into the payments processes that make it easier? I mean, what are some of the components inside your software that people use?
Yeah, so if you kind of break down Tilt into its simplest form, there's three key components of what we do. There's the onboarding process, there's the payment processing component, and there's reporting from a
Okay.
technology perspective. From an onboarding perspective, we are giving an ISV a white labeled merchant digital application for them to be able to onboard all of these merchants onto their platform. And then we handle the complexity of underwriting, KYC, KYB, creating the accounts and getting them provisioned and ready to start processing payments. And so we're handling not only the technology side with the digital application, the white label tools, we're also handling all of the back office components for those merchants. And then on the payment processing side, our gateway is connected into multiple processors. We've got card present, card not present capabilities. We can process ACH payments, EFT payments in Canada. We can do level 2, level 3 payments. We've got all the capabilities that you need from a gateway perspective through the payment processing component. And then from a reporting perspective, we give both the ISV a reporting experience so they can see all of their merchants, all of the payments, all of the deposits, all of the fees across their portfolio. And then each one of their merchants has a white labeled version of that same console so that that merchant can log into a console and look at, payments, deposits, fees, run transactions, etc.
Okay. Okay. So I want to talk about Stripe for a minute because they've revolutionized payments. Let's
I've
face it.
never heard of them.
They're,
Tell me more about Stripe.
they're the 800-pound gorilla in the space. I believe they have an offering that is competitive to yours called Stripe Connect. Maybe
Yep.
you can tell us a little bit about how you can compete with a company the size of Stripe, and what is it that you're bringing that they don't have?
Yeah, so Stripe, they only process about $1 trillion a
Right,
year
I saw
in
that.
payments,
Yes.
so it's not that impressive. I don't know why everybody's talking about Stripe, but yeah, I mean, fundamentally, we compete head to head against Stripe Connect all the time. Over half of our customers come to us from Stripe. If we're going into an RFP, Stripe's got a 90% chance of being, in that RFP, and they're definitely the company that we hear and see about all the time. And when I think about the Stripe Connect product offering, there's kind of two elements of that Stripe Connect offering. There's Stripe Connect Express and Stripe Connect Custom. And the Stripe Connect Express solution is the turnkey solution that most everybody thinks about when they think of the Stripe Connect offering, that startups are plugging in 7 lines of code, 3 days, you're up and running, on payments, but it's powered by Stripe. Their brand is all over that offering. On the other end of the spectrum, you've got the Stripe Custom Connect, which is there's a lot of optionality, but it's a very extensive integration
Right.
process. And so you could spend 6, 9, 12 months building out a custom, integration into that offering. And most software companies don't want to do that. And so how do we compete, against this very robust, very established solution? Thing one is the revenue side. I think a lot of people think of Stripe as the kind of premium, solution in the market, and they charge a pretty penny for it. And so, 2.9% and 30 cents is the kind of standard model. But the reality is, what we've been seeing is that Stripe still isn't negotiating all that much, on pricing with a lot of ISVs, even doing, 100, 200 million in payments volume. And so we're providing those ISVs a greater ability to monetize every dollar flowing through their platform. Thing two is really the branding component, where a lot of the ISVs that come to us are on Stripe Connect Express. They're using a powered by Stripe experience, and they want their brands to be front and center to their merchants. And so at Tild, we provide a turnkey solution where, in 1 minute, you can go in and add your logo, your primary and secondary colors. You can customize your subdomain, your email preferences, your contact info, and then the entire merchant experience, onboarding, consoles, dispute management, transactional emails. That entire experience is branded for your software solution, and you didn't have to build any of that. And then the third component is really the support piece. And there's two components to that. I think, as Stripe's gotten closer to going public, the overall support experience, is not where it was when they first started. But almost the more important piece of this is the go-to-market support element. And so for a lot of the ISVs that we work with, they're really wanting to grow that merchant base. They're wanting to grow their payment revenue stream. And so they're coming to us to say, hey, how should we price this? How should we message it? How should we set up, the onboarding? How should we set up, the website to talk about payments? Can you tell us how we sell against, Stripe? How do we sell against the traditional processors? Because merchants have a choice. To your point, merchants all have plenty of choices, and sometimes they're getting, offers on a daily basis. And so how does that ISV compete, in this category? And we really work side by side with our partners to help them understand how to sell more, payment volume, how to help, drive that activation and the attach rates in their portfolio. And that's something that, our partners find really valuable.
So do you get involved at all when your partners are onboarding one, like every company now, unless you're a total startup just getting going, they have an existing credit card relationship oftentimes. So like the ISV customers, new customers coming on board, do you help them sell and get them kind of on board with their customers, or what do you provide there?
Yeah, at times we do. I think it really depends on what that individual ISV partner needs. Sometimes they need help analyzing statements. So, hey, we've got, 20 customer, a 20 location deal. Here's their statements. Can you help us figure out what their current pricing is, how to price it, and put together a proposal for them? Great, we can do that. A lot of times it's more marketing support. And so let's say, we bring on a customer that has, 500 existing merchants that they want to convert from Stripe over to Tild. We can help them design a marketing campaign coupled with an in-app messaging campaign to help drive those merchants from the prior solution over to Tild. And then sometimes it's just training. The existing sales or customer success team just needs to understand a little bit more about how payments works, how Tild works, and so we'll go in and do training for clients. And so it's not a one size fits all playbook. It really depends on what a partner needs to
Right,
be
right.
successful.
So how does your pricing work? I mean, are you a SaaS product? I mean, I presume you've got some sort of volume type, per transaction pricing. How does it work?
Yeah, so our pricing model is a combination of a SaaS fee and a revenue share model. And so at the base, there's a $2,500 monthly SaaS fee to have access to the platform. And then any revenue you're earning, in excess of that SaaS fee, we're sharing 75% of that revenue stream with the software partner. And so they're earning the lion's share of the revenue on every dollar that's processed through the platform. And we allow our partners to really set the downstream merchant pricing. And so if you want to do flat rate pricing at 2.9% and 30 cents and match Stripe, that's great. If you want to come in at 2.8% and 10 cents to undercut Stripe, that's great too. We also have a lot of partners that do interchange plus pricing as well. And so we put the ISV in control of the pricing to their merchants. And then, we're giving them 75% of the upside between what they charge their merchants and what that actual cost of
Hmm.
processing is.
Hmm. Right. So there's one other question I want to ask. This 2.9% and 30 cents, we've seen that around for a long time. I want to talk about the 2.9%. Do you have off the top of your head the breakdown of where that 2.9% goes? Issuing bank, the acquiring bank, the Visa and MasterCard, or Amex Discover. How is that kind of sliced up?
Yeah. So when you think about the 2.9% and 30 cents, the first split is really, what's the interchange revenue versus the acquiring revenue. And typically on, let's take the 2.9%. It's in our world, about 2.2% is typically the interchange cost, which we can kind of break out in a second. And then there's typically, 70 or 80 basis points of margin that's the acquirer margin, which is kind of the till plus the ISV plus the processor side of the margin equation. And then when you look at the 2.2% that makes up the actual interchange cost, the card brands, and this is this is a bit of a misnomer where when you think about the overall breakout of interchange, there's interchange dues and assessments as kind of a couple of the categories. The interchange is really primarily the revenue that's going to the issuers. So that's kind of the issuing bank side of the revenue stream that really drives the consumer rewards. And that makes up in a credit card transaction the bulk of that interchange revenue. The actual card brands, I think MasterCard just announced that they raised their assessments from 13 basis points to 14 basis points. And that's the primary, revenue driver for the card brands. And so on that interchange, issuer side is getting the vast majority of the revenue stream on the interchange. Card schemes are getting a relatively small take. Acquiring bank is getting a relatively small take. The processors, PayFacs, ISVs are getting a decent chunk of change, and that's kind of broadly speaking how you'd break up that 2.9%.
Right, right. Okay. Okay, I would love to get your perspective on this recent news about the Department of Justice having a settlement
Yeah.
with Visa and MasterCard that has been going on for almost 20 years. And the thing I like, I'm a credit card points junkie. I'm
Same.
very much focused on my my Chase Sapphire Reserve and maximizing my points depending on what type of merchant I am doing business with. And what I was struck to read that now my Chase Sapphire Reserve might end up with a higher price than someone paying with just say a Visa debit card, for example, where right now that I don't think that's allowed. How is this all going to play out?
Yeah, so there were two key components to that ruling. One was on the interchange fees side, and so the ruling was that they agreed to reduce the interchange fees
Right.
by 4 basis points for a period, at least 4 basis points for a period of 3 years, which kind of per the prior conversation, the card brands, despite negotiating these fees, aren't actually the ones capturing the margin
Right.
on
It's the
the
banks, the
interchange
issuing
fees.
banks, right? Yeah.
And so they, kindly agreed to reduce the revenue for, their issuing partners, and then, a week later announced that they're increasing their assessments. And so I think that was a bit of a marketing ploy, in my opinion. I also think that the two possible outcomes are that consumer rewards are going to get squeezed because there's less revenue, or they're going to introduce, higher fees on the credit cards, or they're going to introduce new interchange categories. And so I'm not convinced that there's all that much that's going to change based on the first part of the ruling. The second part is much more interesting to
Mm-hmm.
me. So the second part of the ruling is where they start to talk about surcharging, card steering, and this idea that the merchant now has the flexibility to charge different prices depending on which card you as the consumer bring to the table. And I think, for those of us in the payment space, we've known for a long time that that Chase Sapphire rewards card costs that merchant way more to process than if, you were to use, your Bank of America debit card. But previously, merchants have had no choice. If it's a Visa, they had to honor, that card, and they couldn't discriminate between different, Visa transactions. And so for me, there's a lot of really interesting possibilities of what come out of this ruling. I think the challenge is going to be, practically speaking, what do you want that checkout experience to look like for the consumer? As a small business owner, are you really going to look at you and say, oh, Peter, I see that Chase Sapphire reward card. That's going to be 3.5%, for you to use that. What other cards do you have in your wallet? Like, that's an awkward interaction, at that point of checkout. But the small business owners now have the flexibility to do it. And I think it'll be incumbent upon the processors, technology providers, like ourselves, to try and make that an elegant experience that isn't going to turn off consumers.
I'm just wondering if we're going to get to a point like, you just go, and when you're going out in your local area, right, you'll go, there's all these different sales tax districts, right? And you never know what the final cost is going to be. When you buy something, you just sort of accept that it's going to be between, in Denver, Colorado, it's, 7% to 8%, something along those lines is what sales tax is going to be. I'm just wondering if we're going to get to a point where there's a credit card fee. You have a price, and then if you're using a debit card, the card fee is going to be included in this as a mysterious line item in the checkout, and the debit card will be at, say, at 0.75% or like 1%, and then the Chase Sapphire is going to be at 3.5%. Am I off base there? I've got no expertise in this area. I just was wondering what you think.
I have a really hard time imagining that world is going to exist. I think if you look at it from a consumer behavior perspective, you and I think, are both points junkies, and so I'm looking at this and saying, hey, my city bank credit card gives me 2% flat cash back. If anyone's charging me more than 2% to use that card, I'm never going to pay with that card again. And so I think if you imagine that world existing, that's going to be detrimental to the entire, credit card rewards, scheme program, because it takes away the incentive for you as a consumer, to do that. I also tend to believe that that's just going to be an awkward checkout experience, for a consumer at the point of sale. And so I think for me, I do think that there's a growing trend towards surcharging, within the merchant environment. And I think it'll be really interesting to see as the card brands continue to come out with more, rules and guidelines and regulations, on this, how it actually gets adopted, in the industry.
Okay. Well, looking to the future, I mean, we've really been talking about embedded payments for most of this conversation. So would love to kind of get your take on what you think the future is for embedded payments, and maybe you can combine that answer with what is your vision for Tild?
Yeah, when I look at where the embedded and I'll change it to fintech space is going, I think for a lot of ISVs, payments is really the beachhead when they start thinking about the value that they can bring to small businesses from an embedded fintech perspective. And so my vision for Tild aligns coincidentally with where I think the ISV space is going. I know that's surprising. But I certainly feel like, if you fast forward 5-10 years from now, ISVs are in prime position to offer additional, fintech solutions to the small business owners that they serve. So does that restaurant need access to capital, payroll solutions? Do they need access to insurance? There's all sorts of additional, solutions that these small business owners, need to run their business. And I think us as the incumbent payment provider, being Tild, are in a really unique position to help arm our ISVs with these capabilities to sell into their merchants. And one of the biggest reasons why, I feel that way is that 90+% of our ISV partners leverage our Tild consoles. And so we already control the login experience, the eyeballs, the place that those small business owners go to manage their payments business. And so that's a very logical place to introduce that offer for lending or those additional product offerings. And it's a value add service to those small business owners that need those solutions. And it's an additional revenue stream, for our ISV partners. And so I feel like that's, one of the trends that I see, evolving over the coming years. And then the second is really the idea of like iPhone, Android tap to phone capabilities. I think for a long time, card present hardware has just been prohibitively expensive. And the idea that, you can use your iPhone to accept, tap transactions is just incredibly fascinating to me. And I'm very excited to see, what the adoption of that technology looks like in the years to come.
Right. Yes, that we haven't even begun to kind of go down that path. There's going to be all sorts of interesting developments there, I'm sure. So anyway, Caleb, really fascinating chatting with you. Thank you for giving us the payments lesson there. I appreciate that. And best of luck to you.
Yeah, thanks so much for having me on the show today. And if anybody wants to follow along on the Tild journey, LinkedIn is a great place to follow me, Caleb Avery, and then the Tild website is a great place if you want to learn more about Tild. But thanks so much for the opportunity, and thanks for having me on the show.
Sure, and we'll be sure to link to those as well. So thanks again. Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice, and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.